Episode 7: Portfolio Rebalancing and Maintenance. Keeping your investments on track. Why rebalancing matters and how drift happens. When you first design your asset allocation, you've chosen it carefully, a mix of stocks, bonds, and maybe other assets that match your goals, your timeline, and your risk tolerance. But here's the thing. Markets don't stand still, and neither does your portfolio. Imagine you start with 60% stocks and 40% bonds. If stocks have a strong year, that mix could drift to 70% stocks and 30% bonds. That's not just a number change, it's a risk change. You now have a more aggressive portfolio than you intended, whether you realized it or not. This is what we call portfolio drift, the silent reshaping of your portfolio's risk profile over time. The silent risk creep. Why does drift matter so much? Because it works quietly in the background. If you never check your allocation, you can end up with a portfolio completely different from what you started with. Between 1995 and 1999, US stocks had an incredible run. A 60/40ths investor who didn't rebalance for 5 years ended up with more than 80% in stocks by early 2000. When the dot-com crash hit, their losses were far deeper than if they'd stayed balanced. How rebalancing protects you. Rebalancing is the process of bringing your portfolio back to its original target mix. If stocks rise above your set percentage, you trim them back and add to bonds or other assets. If stocks fall, you do the opposite, buying more while prices are down. It's counterintuitive because it often means selling your best performing assets and buying the ones that have struggled. But this, buy low, sell high, discipline is what keeps your risk in check. The long-term impact of rebalancing. Vanguard studied portfolios from 1926 to 2015 and found that annual rebalancing reduced volatility by 12 to 15% compared to never rebalancing, without a meaningful reduction in returns. In fact, in some cases, returns improved slightly because of the disciplined buy low sell high effect. The goal of this episode, in the rest of this episode, we're going to look at different rebalancing strategies and which work best. How to keep costs and taxes low when you rebalance. How to automate the process so emotions don't interfere. The behavioral challenges of rebalancing and how to overcome them. Real-world examples of portfolios with and without rebalancing. Because building a great allocation is only half the battle, keeping it intact is where real, long-term wealth building happens. Rebalancing strategies: calendar-based, threshold-based, and hybrid approaches. Calendar-based rebalancing. Calendar-based rebalancing is exactly what it sounds like. You rebalance at fixed intervals, regardless of market conditions. This could be quarterly, semi-annually, or annually. Annual rebalancing is the most common because it balances discipline with efficiency. It prevents overtrading while still keeping your portfolio aligned with your target mix. Historical insight. Vanguard's research on 60/40ths portfolios from 1926 to 2021 found that annual rebalancing delivered almost identical returns to more frequent schedules but with fewer trades and lower costs. Threshold-based rebalancing. Instead of the calendar telling you when to rebalance, threshold-based methods wait until an asset drifts beyond a set percentage from its target. Example: if your target is 60% stocks and 40% bonds, you might set a 5% threshold. If stocks hit 65% or drop to 55%, you rebalance back to target. Why it works. Threshold rebalancing tends to act faster during volatile markets, helping keep risk in check during extreme moves. Research from Vanguard and the CFA Institute shows this approach often produces slightly better risk-adjusted returns than strict calendar-based rebalancing. Hybrid rebalancing. Hybrid rebalancing combines the best of both worlds. You check your portfolio at regular intervals, but you only rebalance if a threshold has been breached. Example: you review every quarter, but you only rebalance if an asset class has drifted more than 5% from target. This keeps costs and taxes low while still catching major drifts quickly. Opportunistic rebalancing. Some institutional investors also use opportunistic rebalancing, which involves adding funds to underperforming asset classes when they hit attractive valuation levels, essentially buying more when the market is offering a sale. While effective, this approach requires a strong grasp of market valuations and the discipline to act when sentiment is negative. Which strategy is best? There's no universal, best strategy. the best method is the one you'll stick to consistently. If you value simplicity, calendar-based works fine. If you want precision, threshold or hybrid approaches are often better. If you're an experienced investor and want to squeeze a bit more performance, opportunistic methods may work, but they require vigilance and a solid valuation framework. Tax and cost considerations in rebalancing. Why taxes matter in rebalancing. Rebalancing often involves selling appreciated assets. In taxable accounts, this can trigger capital gains taxes, which eat into your returns if not managed carefully. Short-term capital gains, assets held less than a year, are taxed at your regular income tax rate, which can be high. Long-term capital gains, assets held more than a year, are taxed at lower rates in most countries, making them preferable when selling. Bottom line: if you rebalance without considering taxes, you can end up giving away a big chunk of your gains. Using tax-advantaged accounts. A powerful way to reduce the tax bite is to rebalance inside tax-advantaged accounts like IRAs, 401ks, RRSPs, or ISAs. Inside these accounts, you can buy and sell without immediate tax consequences. This means you can keep your allocation tight without creating surprise tax bills. Asset location strategy. Think of asset location as tax optimization's cousin. Instead of spreading assets evenly across all accounts, you place them where they're most tax efficient. Bonds often go in tax-advantaged accounts because their interest is taxed as ordinary income. Stocks can be placed in taxable accounts since long-term gains and qualified dividends are usually taxed at lower rates. REITs and other high-yield assets are best sheltered from taxes. By combining asset location with rebalancing, you can maintain your portfolio mix and reduce annual tax drag. Minimizing transaction costs. Taxes aren't the only hidden cost. Frequent rebalancing in accounts with trading fees can erode returns. Even small costs, like $5 to $10 per trade, add up over years. Use commission-free ETFs or no-load index funds where possible. Consider rebalancing with new contributions instead of selling, adding money to underweight assets without triggering sales. If you need to sell, consolidate trades to minimize fees. The tax loss harvesting bonus. Sometimes rebalancing can be paired with tax loss harvesting, selling investments at a loss to offset gains elsewhere. This lets you rebalance and cut your tax bill. Example: if your bonds are overweight and your international stocks are down for the year, selling some stocks can both restore balance and provide a tax deduction. Automation and tools for rebalancing. Why automation helps. Rebalancing sounds simple in theory, but in practice, emotions get in the way. When markets are up, you hesitate to sell winners. When markets are down, you resist buying the losers. Automation removes hesitation and enforces discipline. Your portfolio adjusts whether your emotions like it or not. Built-in broker tools. Many online brokers and robo-advisors offer free automatic rebalancing features. Robo-advisors like Betterment, Wealthfront, and M1 Finance will continuously monitor your allocation and make small trades to keep it on target. Full-service brokers like Fidelity, Vanguard, and Schwab allow you to schedule periodic rebalances or set drift thresholds for auto-adjustment. This set it and forget it approach means you're not relying on memory or willpower. Automating through contributions. If you regularly add money to your portfolio, you can rebalance without selling by directing new contributions into underweight asset classes. Example: if stocks are 3% under target, you put all new contributions into stocks until balance is restored. This avoids both taxes and transaction costs. Spreadsheets and portfolio trackers. If you prefer a DIY approach, spreadsheets can track your target allocation and signal when rebalancing is needed. Popular tools: Google Sheets or Excel, customizable formulas to track drift. Portfolio Visualizer, historical analysis and rebalancing simulations. Morningstar Portfolio Manager, allocation tracking with alerts. Alerts and monitoring. Some investors prefer manual control but still want a nudge when things drift. Many brokerages let you set email or app alerts when allocations move beyond set percentages. This hybrid approach keeps you aware without forcing you to check constantly. The one-button rule. If your rebalancing process takes more than 1 or 2 steps, you're less likely to do it consistently. Automation should make it so easy that avoiding it is harder than sticking to it. The psychology of rebalancing. Why rebalancing feels wrong in the moment. Rebalancing forces you to do the opposite of what feels comfortable. Sell the assets that have been winning. Buy the assets that have been struggling. Human nature craves momentum. We want to keep riding winners and avoid adding to losers. But successful investing often means doing the exact opposite. The loss aversion effect. Behavioral finance research shows we feel the pain of losses about twice as strongly as the pleasure of equivalent gains. This makes it emotionally hard to sell a stock that's up 40% and buy one that's down 20%, even when the data says it's the right move. The recency bias trap. Our brains overweight recent events. If tech stocks have been hot for the last 2 years, recency bias makes us believe they'll keep winning forever. That's when portfolios get dangerously overweight in one sector. How to overcome the biases? Write down the rules. Have a simple rebalancing policy in writing so you don't have to make decisions in the heat of the moment. Automate it. Let a system execute trades according to your rules. Review history. Looking at long-term data reminds you that no asset wins forever. Accountability partner. Tell a spouse, friend, or advisor your rules so they can call you out when you're about to break them. Framing rebalancing as risk control, not market timing. One mental shift that helps. See rebalancing not as trying to predict the market, but as controlling your exposure to risk. You're not betting against the winners, you're preventing your portfolio from becoming unbalanced and more volatile than you can handle. The patience factor. Rebalancing doesn't always feel rewarding in the short term. Sometimes you'll trim a winning asset, and it will keep rising for months before slowing down. That's okay. The benefit of rebalancing often shows up over years, not weeks. Final checklist and case studies. Step-by-step rebalancing checklist. Set your target allocation. Example: 60% stocks, 30% bonds, 10% real estate. Make sure it aligns with your goals, time horizon, and risk tolerance. Choose your method: calendar-based, threshold-based, hybrid, or opportunistic. Commit to the method before you invest further. Define drift limits. Example: plus 5% from target weight for any asset class. Pick your rebalancing accounts. Prioritize tax-advantaged accounts for trades when possible. Leverage new contributions. Direct new money to underweight assets before selling. Minimize costs. Use commission-free ETFs, consolidate trades, and watch spreads. Document every adjustment. Keep a log of what you change, when, and why. Automate where possible. Use broker tools, robo-advisors, or spreadsheets to keep you on track. Review annually. Even if you haven't hit drift limits, review to confirm alignment with your goals. Case study 1: the 60/40ths drift problem. From 2009 to 2021, U.S. stocks surged. A 60/40ths investor who never rebalanced ended up at 80/20ths by late 2021. When the 2022 bear market hit, their losses were far steeper than intended. A disciplined annual rebalance kept the portfolio closer to 60/40ths, reducing volatility and drawdowns. Case study 2: threshold rebalancing in volatile markets. Between 2000 to 2010, markets saw 2 major bear markets. Investors using a 5% threshold rebalancing method consistently bought stocks after large drops and trimmed after rallies. Over the decade, they achieved slightly higher returns and much lower volatility than those who rebalanced only once a year. Case study 3: the tax-smart investor. An investor with a mix of taxable and tax-advantaged accounts used asset location to place bonds in their IRA and stocks in their taxable account. They rebalanced inside the IRA whenever possible. Result: they avoided triggering taxable gains in their brokerage account for over 10 years while keeping allocation tight. Final takeaway: rebalancing isn't exciting. It's not about chasing hot stocks or making perfect predictions. But it's one of the most powerful, proven ways to protect your portfolio and keep it aligned with your goals. A great asset allocation can only serve you if you maintain it. Rebalancing is the quiet discipline that keeps your investments working as intended, year after year.